Hello friends, my name is Saurav Vatwa and today I'm going to cover this topic. This is sole trader versus company. I have often found confusion in new business mind. If you're trying to set up a new business, you might have come to this problem. Oh, should I start as a sole trader or should I form a company? So in this video I'll try to cover what is sole trader and what is a limited liability company so that you can choose between the two. So remember one thing, sole trader, which is this, it is not a separate legal entity. Okay, it is not a separate legal entity. So what is this? It is you, my friend. This is you doing the business on your name. So you will be registered to file the tax returns on your own. You will be registered to file the GST returns, VAT returns, business activity statement, whatever you call it, whatever part of the world you are. This is you. Everything will be done by you as such. However, company is a separate legal entity. So company is not you, it's a separate legal entity. In a simple words, company can sign its own documents. It can form a relationship with the employees on its own. It can sign a sale and purchase agreement to purchase a business on its own. It can uh, hire and fire people. If someone wants to sue, they won't sue you, they'll sue the company, and you can straight away say, this is not me, buddy, this is company, go and sue the company. And company will be in problem. If company is too much of a problem, come down here. Company has a limited liability. So what this means, it's up to the assets of the company. For example, if the company has $1,000 in its bank account, okay, so this is it. You're only going to pay $1,000, nothing more than that. All your personal assets would be protected. They cannot come to you unless you have given a personal guarantees. They can't come to you. However, in some instances, such as if you go to a bank loan and things like that, vehicle loan, they will always get you to sign a personal guarantee. They will not release money to you before signing that. So be careful what kind of funding you're receiving and what you're signing. So be careful around there. However, sole trader, it's you, so you can't escape. This is unlimited liability. It's not limited, it's unlimited. Whatever you have done, you have to pay. You cannot escape. So if your business is too risky and you think, oh, form a company. Example, if you are a property developer and you want to build a house, subdivide that and sell it into different lots. You know that down the line, few years from now, if something is not working in the house, they'll come and sue you. Whoa, it's a personal. They'll sue you. You're a sole trader. They'll come and find you. You can't escape. It's a company. You can shut the company. See you later. I don't want to see you who you are. Go and see the builder who has built the houses. Okay? The ownership, the ownership is by the shareholders. So shareholders are the person who hold the company, who own the company into certain percentages. In a rule of thumb is 100%. So 100% is the ownership. Out of that, it 100% is the shareholding percentage. The shares within 100% could be unlimited. It could be one share, it could be 1 million share. That does not matter. Number of shares does not matter. The percentage matter. So who owns it? If it's just one person, you will be the 100% shareholder. If there are 5%, there will be 20% shareholder each. If they are 10%, 10% shareholder each. If husband and wife only, 50-50. That would be the percentage between you. And if it's an ownership, oh, there is no ownership, it's owned by you. There's no ownership, right? Straight away. Taxation, progressive tax rate. So whatever you earn, you pay tax on that. If you're in Australia, I think you don't pay tax up to $10,000, but countries like New Zealand, you have to pay tax to start with. Top of my head, other countries have different regimes. It's first certain money is not taxed, after that it's taxed at 10%, then 20%, then 30%. It's a marginal tax rate, which is a progressive. As you earn more, you pay more. You earn less, you pay less. There is the structure they have. However, if you are a company in New Zealand, this is where I am, the company tax rate is 28%. It's likely to change, but we do not know when. Compliance, well, as the name suggests, it's a simple tax return, so it's a fewer compliance. You're just filing one income tax return at the end of the year, and that's it. But here, you got to file a reporting to company's office and annual financial statements to be prepared, tax return for the business, which is a company, to be submitted along with personal returns. Director duties: director must know the financial responsibility and duties and must be able to fulfill those duties, which is not a major thing, those director duties, but this is just to scare people. You also have to do similar duties in any business, whether you are a sole trader or not. But as a director, you should know when company is solvent, when company is insolvent, when distribution of dividend to be done, when not to be done, things like that. Just understand the finances before you becoming a director. That's all it's trying to say. As it says, profit distribution, all the profit is distributed to the owner. So if you earn $10,000 and there is your net income, everything goes to the owner. Owner will pay tax on its marginal tax rate, right? But if you are the company, the company will pay the tax and the profit distribution will come to the owners who are the shareholders by two ways. First option is salary. You can pay salary to the owners, so the working owners can get paid. If 10,000 is a income, in similar example, that 10,000 could be a salary and profit distribution can be done through here. Else it could be dividend. It's slightly more complex subject, but rule of thumb is if 10,000 is the profit, assuming 28% tax has been paid, which is $2,800, balance left is $7,200. So that $7,200 what's left will be given to you as dividend. So this is the concept, general principle. There are few things attached to it, how much credits I will get and stuff, but this is what you understand. Profit distribution can go to owner, but for the company, two ways: salaries to the owners or the dividends. Now I'm talking about a small business context here. Creditability, well, of course, it's a lower perceived creditability and higher perceived creditability. Example, you want some guy to put a new roof on your house, a proper company giving you a quotation with lots of Google reviews and good structure, good business process, management documents, quotation system, invoicing system, you're more likely to trust them. But one guy just roll up, they say, hey, I'll do the job on my own, so you will have less perceived creditability. However, this is someone's perception. This perception can be changed by operating in a very nice manner so that you can argue that I'm a credible and experienced person. Ongoing cost, of course, less work is here, so it's a lower cost to maintain. And there is no setup cost. Wow, there's no setup cost because you are you. We just need your tax number to work on the taxes. However, slightly more higher compliance cost here because there will be cost to set it up. Once we set up a company, there is cost involved, and on the management side of it, there will be a cost involved. But again, we're not talking about a lot of cost here. Something can easily be managed. It's not too much. Losses, of course, the losses can offset under a personal income. So what does it mean? If you got two kind of income, and income A is your rental income of 10,000 and income B is your self-employment income of 5,000, which is a loss. So that loss can offset against other parts of the income. A rental income might have certain criteria for loss offset, but let's put it example when we have self-employment income 5,000 and you made a loss in driving Uber, or you got a lot of depreciation. So the idea is uh, you can have losses offset against multiple sources of income. Employment income versus self-employment income can be used. You got 100,000 employee income and 10,000 self-employment losses. Like you're trying to do a business selling something online and you made a loss there of 10,000. So that 10,000 loss can offset against your employment income. It's an offset of losses. So if you are about to see any losses or you may experience any losses, you may consider sole trading because you can offset the losses. But company, on the other hand, my friend, cannot offset any losses. These losses will be retained in the business until the future income comes in. Succession planning. If you die, if you want to retire, how business will continue. So harder to transfer because everything is on your name, right? It's little harder. Easier to transfer because everything is on shares. The shares can be bought by the new owners and they can take over the business, or you can sell the business as it is. They can form a new company and buy it as it is. This is all about the difference between sole trading and a company. If you have any questions, feel free to ask in comment box. Happy to answer. Thank you for watching this.